print, email, Facebook, Twitter. More analysis. RBA is stuck on hold again as interest rates go up anyway. The more it changes, the more it's the same thing. It may have been written about the Australian economy if hadn't come from the pen of the 19th century French critic and journalist Jean-Baptiste Alphonse Carr. This week's frenzy of activity on the Australian economic front is likely to support Carr's universal maxim. The RBA will keep rates on hold just as it is since August 2016, and Australia's economy as measured by gross domestic product will muddle along at subpar growth. This is despite all manner of underlying changes in the domestic and global economies. The RBA remains staunchly of the view that the current historic low of 1.5% for its cash rate is the right setting, and the next move, when it happens, will be up. It was not so long ago the popular view was there would be 2 rate hikes this year. No one is talking that book now. For the record, the market has priced in a 0% chance of move on Tuesday. A full 25 basis point rise is not priced in until November 2019, and even that keeps sliding into the future. What about a cut? As more economists and investment houses shift their guesstimate of when the RBA will move to further over the horizon, TD Securities and Nomura are the latest to give up on 2018. There is a groundswell of opinion the RBA has got it wrong, and a cut is in order. In a technical research piece on where Australia's neutral interest rate lies, Credit Suisse economist Damien Bowie suggests interest rates have been a lot tighter than people realize, and it is time to revisit the current setting, while not explicitly saying a cut is needed. Mr. Bowie says the neutral rate is around 2% and likely to shift down closer to 1% as credit conditions tighten and banks raise commercial rates. The neutral, or natural, rate of interest is a fairly theoretical concept, estimating where the real short-term interest rate would be to keep GDP as growing at its long-term average, inflation stable and employment full. The minutes from the RBA's July meeting last year caused quite a kerfuffle, with the suggestion the neutral nominal cash rate would need to rise to around 3.5% to keep inflation in check and growth at reasonable levels. The theory goes, if the real policy rate, currently 1.5%, is above the neutral rate, then monetary policy is exerting a contractionary influence on the economy. Mr. Bowie's view is the neutral rate is low and falling. His estimate of neutral would be 2.1%, assuming banks had passed on all the benefits of the RBA's cutting. They didn't, and the pass-through transmission of RBA decisions to the rates banks charge is likely to weaken more in an environment where funding costs keep rising. Indeed, the Credit Suisse view is the monetary transmission is impaired, and the neutral rate is probably getting closer to 1.5%, and perhaps heading to 1%. At those levels, the RBA's current policy is contractionary at a time growth is sub-trend, inflation is low and employment far from full. In other words, the relationship between the RBA's interest rates and the real world of what banks charge has broken down, and there is no way the bank would feel comfortable with its cash rate that far above neutral in the current environment. Mortgage rates are heading up, as Mr. Bowie says. Interbank credit spreads are a powerful leading indicator of where mortgage rates are heading. Interbank spreads are getting wider, so mortgages rates will go up. So the RBA's settings are currently getting tighter, even when it does nothing. Although the RBA is keeping the cash rate steady for now, the market is doing a lot of tightening for the bank. Mr. Bowie said, currently, wide interbank spreads are consistent with a widening of the mortgage spread of at least 30 basis points over the next few quarters. So if the RBA does not cut rates, and that is unlikely, given its determination to raise them, out-of-cycle rate hikes from the major banks are on their way, and conditions will get much tougher for the bulk of borrowers holding variable rate loans. If spreads narrow from here, the bank is well placed to carry through on its medium-term plan to hike rates, Mr. Bowie said. But if spreads remain elevated, or widen even further, the bank must revise down its view of the neutral rate, and rethink the appropriateness of current rate settings. Market Economics Managing Director Stephen Kukulas is a bit more blunt in his assessment. The RBA needs to cut, Mr. Kukulas said. Is 1.5% really that loose? No, because unemployment is not falling, inflation is below the RBA's target range and has been for 3 years, and wages growth is at record lows. It seems policy is not too easy. If it's too easy for too long, you will have inflation taking off. It hasn't and is unlikely to, he said. Currently 1.5% is still too high. Mr. Kukulas said failing an interest rate cut, and he is not holding his breath on that one, any interest rate rises are a long way into the future, and if they do come, there will not be all that many. Mr. Kukulas's benchmarks to start a cycle of rate rises are straightforward: annual GDP growth above 3.25%, the unemployment rate falling to at least 5%, wages growth lifting to 3% and beyond, and underlying inflation increasing to 2.5%. No boxes ticked there. GDP to pick up pace, but still below trend on the first point. GDP is stuck well below 3%, and that is where it will remain when the first quarter national accounts are published on Wednesday. The NAB economics team says the first quarter is shaping up as better than the sluggish end to 2017. NAB forecasts are slightly stronger than consensus, GDP growing at 0.8% over the quarter and 2.7%. We expect growth across both the household and business sectors, with consumption growth making a significant contribution. In addition to business investment, where the handover to the non-mining sector is set to continue, NAB's Gareth Spence and Tony Kelly wrote over the weekend. However, the contribution from consumption growth is likely to be short-lived as it faces a number of headwinds such as the weakness in wages, they added. While GDP is the headline-grabbing number in the national accounts, there are other things that are perhaps more pertinent in Wednesday's release to the average Australian, such as whether they are richer or poorer, or how much do they have to spend, judging by real net disposable income per capita in the last quarter's national accounts. Things are getting tougher. If this metric doesn't start picking up, it is difficult to see the whole consumption-driven growth thing working too well. Falling disposable incomes is clearly one big reason retailers are struggling. Having bounced out of the blocks, helping GDP projections along the way, retail sales have noticeably cooled. March sales were flat, and the forecast for April, when figures are released on Monday, is bleaker. Markets rebound despite trade tensions. Global markets generally finished the week in a positive mood as stronger U.S. jobs numbers seem to trump rising trade and political tensions. Okay, so the on-again, off-again anti-establishment coalition in Italy finally got the keys to government. Spain's government was sacked and U.S. decided to reinstitute tariffs against everyone not named Australia, Argentina, Brazil, and South Korea, but jobs and wage growth beat expectations, so that was a buy. The ASX, which missed the wave on Friday, looks likely to catch it on Monday's opening. The strong jobs data also pushed up U.S. Treasury bond yields on the expectation the Federal Reserve could increase the pace of interest rate rises this year. June and September rate rises firmed in the betting, as did the betting on another one in December. The RBA can only look on forlornly, wondering when it can move from where it doesn't want to be. All this speculation is putting upward pressure on the US dollar. That may not be a great thing, just as the White House flips back to erecting trade barriers at all its ports. Its war, steel and aluminium versus pork bellies and bourbon. Mr. Trump's decision not to roll over the tariff exemptions to Europe, Mexico, China and Canada, he seemed particularly grumpy with the Canadians, brought pretty swift retaliation. The EU immediately targeted bourbon, jeans and Harley Davidson motorcycles for tariffs, while Mexico decided US pork bellies, apples, grapes, blueberries and flat steel needed a bit more tax applied on the way across the border. Canada hit back more with reason than an eye-for-eye tariff for tariff fundamentalism. That Canada could be a national security threat to the US is inconceivable, Canadian Prime Minister Justin Trudeau said, pointing out how many Canadians had died beside US soldiers over the years. These tariffs are an affront to the long-standing security partnership between Canada and the United States. Yes, Mr. Trudeau, but what about those US farmers Canadians have brutalized over the years? Paradoxically enough, the US farmers Mr. Trump says he is fighting for are likely to be among the collateral damage when any trade war gets serious. For a start, the stronger dollar will make it tougher for the farmers to export their goods, even without the prospect or retaliatory tariffs. Of course, bringing back the 25% on steel and 10% on aluminium are probably just the start. The Chinese front is opened up with a $150 billion wall being erected again as Commerce Secretary Wilbur Ross has now thrown imported cars and car parts into the mix, muttering darkly they are harming national security interests and as such should be subject to new tariffs. Australian date event forecast Monday 4/6/2108 company profits Q1, GDP component, should be stronger than previous quarter, +3 PC inventory Q1, another GDP partial, flat, not much of a contribution retail sales April, an economic black spot, flat in March, could be negative this time Tuesday 5/6/2018 RBA rate decision no change current account Q1, also feeds into GDP. Deficit may narrow to around $10 billion Wednesday 6/6/2018 GDP Q1, may pick up pace, growing at 2.7 PCE Thursday 7/6/2018 Construction Index May, activity expanding, but other data points to construction softening Wesfarmers update Investor Day, further updates on Coles spin-off and UK retreat Friday 8/6/2018 Overseas date event forecast Monday 4/6/2108 US, factory orders April, flat Tuesday 5/6/2018 U, retail sales April, sluggish growth, around 2 PCEOUs manufacturing survey May, ISM survey, activity expanding solidly Wednesday 6/6/2018 US, labor costs Q1, unit labor costs picking up slowly, +2.8 PCEOUs, trade balance April, another big deficit around $50 billion interest in balance with China US, mortgage applications June, housing getting softer Thursday 7/6/2018 U, GDP Q1, final reading steady at 2.5 PC growth May Friday 8/6/2018 JN, trade balance April, solid surplus print email Facebook Twitter more